This is the story of a general who pushed his army to the limits of human endurance. The story of a mind so brilliant that it brought Rome to the brink of destruction.
Hi, welcome to this video today, which is all about trading market turning points and catching the big trend changes. And if you know how to do this correctly, you can trade with very low risk and very high profit potential. And in this video, I'm going to explain a simple strategy and how you do this. Now, I started the video with a clip there of Hannibal of Carthage, one of the most famous generals of all time. And you might be thinking, well, what's he got to do with Forex trading? Well, what he's got to do with Forex trading was he was the master of the flanking attack. Now, he fought Rome for years. He had a much smaller army, yet he was able to beat them time and time again because he'd mastered the art of hitting the flank. Okay, now the flank is where basically an army is at its weakest. You never want to hit it head on. You want to hit it when it's stretched out at the flanks. And it's a very similar situation in Forex trading. You never want to be fighting a trend when it's going up gently. What you want to do is wait for a big price spike to the upside or downside, and then you basically want to hit it. When the price goes up too quickly, you'll see price spikes all the time. Those price spikes never last. They always come back to more realistic levels. So when the price spikes too far away from a moving average, and the moving average I'm going to use here is the 20-day moving average, you've got an opportunity to basically hit the flank and basically catch that turning point. So how do you actually do it? Well, basically just look for pairs that are spiking too far too quickly to the upside or downside. You should have high volatility. And then what you want to do is basically measure how overbought or oversold the market is. And you can do this with a variety of momentum indicators. Let's take four of the most common, the ADX, the RSI, the stochastic, and the MACD. Now, my favorite would be the stochastic, but it's up to you which you use. What you want is momentum. Let's say prices spike too far to the upside. You want momentum to be overbought, okay? But don't just look for it to be overbought. Look for it to be at a chart extreme. And what I mean by a chart extreme is go back a year and basically see how overbought the momentum indicator is. If it's most overbought for a year, then you've probably got a great trading opportunity coming. What you want to do is you'll obviously see momentum overbought. Just wait for divergence. So just wait for a turn down on momentum, so momentum to diverge from price. Let's say it's an up move, go short, okay? And what you want to do then is just look at the end of the trading day after you've gone short. If prices are closing near a low, okay, that is probably going to follow through the next day. If prices come back to your entry or trade slightly above it after you enter, cover your position and wait for another opportunity to get short. But let's say finishes near the low, that's it. You hold that position, put your stop behind the highs, okay? But don't put it just 10 pips behind the high. Give it a little bit of room. Most people who would be trading short will be very, very close with their stop. Don't make that mistake. Put at least 50 or 100 pips back to give it a little bit of room just in case you get that one last move up to the highs, okay? Once you're in, the level to look for on the downside is the 20-day moving average. If ever you have a big price spike, you'll very often see it come back to that 20-day moving average. It's a great moving average to target. So basically look for support and resistance around a 20-day moving average and look to take your profit just above. Don't wait for a test of the level in case you get a bounce. You want to be out early. Now, the strategy sounds very simple, and it is. What you have to do with it, though, is you need to be very patient, okay? And you need to look just for the real extremes, not just an extreme on momentum, overbought or oversold, but a real chart extreme, so that the price it's overbought or oversold in a yearly period. Now, price spikes always fade. You can see that on any chart. And they come back to a mean average. And a mean average basically is the level you want to target. I've given you 20 days as a mean average. If you try it, you'll see how good it is as a level to target when prices spike too far to the upside or too far to the downside. Markets, will always spike on greed or fear too far to the upside or downside. And history proves that these price spikes never last and prices come back to more realistic levels. The actual strategy I've outlined is very simple. It's very effective. You'll be going against the majority opinion most of the time, but don't let that worry you. The more bullish the market is of prices going up or bearish of prices going down, the better. You want to be trading against the herd. The herd are always wrong at turning points, and if you use the simple strategy in close, you can make a lot of money with it. Thank you for listening to me. Take care and have a good day.